But
let's talk about buying a home, because this is something that everyone aspires to do, or almost everyone aspires to do. There's a little note here, like you can buy a home with your Valentine.
Make sure you've had at least 2 Valentines with them before you buy a house. Suggestion, I know some of you have not and have had done very well, but just casual suggestion.
yeah. I mean, it's not the worst piece of advice I've ever heard. But this isn't a love life advice show either. So let's start with step 1. You're interested in buying a home. Where you have to begin is with the bank pre-approval process. And I should have said actually mortgage pre-approval process, because there's many avenues. There are these little online pre-approval things, which are not super reliable. They're basically, you fill out a form and it's an excuse for someone to contact you.
Yeah.
And then there is going into your bank brokerage, which I'm not a big advocate of, because, banks, the person there at the bank, they may be very, very capable, but they can only offer the products of that particular bank. And they likely do not deal exclusively with mortgages, which means they maybe don't have the same level of expertise. And if you have a unique file, they may not be a fit for you. So personally, I recommend going with a mortgage broker who has access to many different lenders and only does mortgages.
And sometimes can get you lower rates.
And sometimes can get you lower rates, better product, something that has allowance in for renovations, all of these different things. That is step 1.
Yeah. And the other thing, like with brokers, is if you're looking to potentially buy multiple or make a transition, they can hear your whole picture and work with you.
Yes.
You can also, this sounds terrible, but you can talk openly and honestly with a broker, and they're going to work with you to get your mortgage, get you the best product possible. Like Chandler was kind of saying, is the banker, nothing against them, but they can only offer what they have in the bank. Technically, some of the stuff that you're going to say to them is going to go against what they have on their checklist to approve you. Mm-hmm. And additionally, again, I say this a lot, but people forget that banks aren't necessarily your friend. Like, they're another business and they're selling you a product. Mm-hmm. Credit cards are products. Line of credit's a product. Mortgage is a product. So they're going to try and push you into something. They shouldn't like aggressively, but they're going to kind of try and sell you something that makes the most sense. That's why a lot of people, when they make their term selections, I find when I speak to them, they're like, well, the bank recommended it. And a lot of times it's not necessarily the best term for them. Additionally, there's products like life insurance and other things that go on top of that they'll all often try and sell to you that really aren't the greatest thing for you.
Absolutely.
But they're on a requirement basis to meet a certain amount of production in selling those products. And so it's just something to consider when you go in there, is to be, if you are going to work with a bank, be eyes wide open and try and get a second opinion. But I agree with Chandler that brokers are really important when you're looking at your full picture.
And some people say, but I've banked with so-and-so my whole life. I like that it's on the same online bank. And I get that entirely. Most independent brokers have access to all the major lenders or close to all the major lenders. So you may say, hey, I want to be in a BMO product. I may want to be in a TD product. I want to be in a Scotiabank product. They'll have access to those products in a lot of cases. You just then have someone who is there capturing you and marketing you to the lender, showing you in your best light.
Here's the even last crazy topic I'm going to say about why brokers can be of value. We've had this scenario, and I think this broker might come on to join us, but he can beat the rates that the bank is offering due to the volume of mortgages that he gives. So because
sometimes that is the case. Yeah.
So you might bank with Scotiabank and they might offer you 2%, but because this broker does 300 mortgages a year with Scotia, he actually gets a special rate discount that he can offer that's cheaper than what a branch can offer you. So you can go into Scotia, everything can be perfect. They'll be like, yeah, we'll give it to you for 2%. You go chat with him, 1.8%. He can beat that rate.
And not always.
Not always.
Right?
Not always. But this is why it's worthwhile chatting. You're not tied to any of these people. Like, you're not signing an exclusive agreement. You meet with them. If it's not the right fit, they don't get what you're looking for, or they're not giving you anything better, then you don't have to work with that person. But it's worthwhile considering and chatting with someone to see, because they might honestly have something better for you that could fit your picture.
Also, if you're looking to invest, a particular bank might have different calculations for your rental income. They may have different limitations when you go to refinance. You may have different penalties if you break your mortgage early. So if you are trying to go from one property to another property to another property, sitting down with a mortgage broker gives you a better opportunity to paint that picture for them and have a partner then through this journey.
Yeah.
At the bank, there's a lot of turnover. You go there 2 years later and there's a different person that works there.
Yeah. And there's, again, the other items are your credit rating. So if you have any issues with your credit score, the big standard banks are just instantly going to say, oh, we can't because it doesn't fit our criteria. If you're a business owner or have any other income besides a biweekly paycheck, they're going to go, we don't really look at that.
Yep.
That includes rental income and if they do, a lot of the grade A banks will just say, we cut it in half. I'm like, what? Like, how do?
Yeah, we cut it in half. We add it to your gross income, and we let you debt service 30% of it. So you take $1,000, and it goes down to about 500. Yeah, like $200.
$300. Like it becomes worthless for you. And then the last one you have on here with an exclamation point, you don't pay them.
Yeah, and someone could say, well, you kind of indirectly do, but they essentially get a finder's fee from the lender to bring you to that product. So there's no obligation, there's no risk, and they're highly motivated to get you into a product.
Yeah.
Because that is how they get paid. So rather than someone who is salary based, and if you have a complicated file, they go, oh my gosh, this is a complicated file. I'm gonna have to really put some effort into this, and it doesn't change what I get paid. A lot of people who are in the real estate industry are very money incentivized, and they like people who are paid on commission and hustle.
Yeah.
Brokers, independent brokers, that's how they're paid, which is great for the consumer, and it gives someone who's going to advocate for your file. So step one, get that pre-approval. That will give you your budget. It'll also give you your monthly payment. It'll also give you your down payment amount.
Yeah. Okay. And within that, let's go for the couple things of what gets you the approval amount. Like, what are the things that are going to impact your approval amount? How am I approved? Is it purely my credit? Is it income? It's both, and it includes other debts that you're carrying.
Yeah.
So something to consider. Obviously, your income is probably pretty much your number one factor on the dollar amount that you're going to get approved. And then your income is going to impact your rate. Now, the things that greatly impact the ability to borrow money are the other debts that you carry, and that includes student loans, unsecured line of credit, credit cards,
car payments.
And car payments. I'd say those are like the main ones. The biggest one and the biggest issue I see for a majority of people, to be honest, is a vehicle payment.
Yeah, and I wanted to ask you about this, but just to break that down a little bit, for easy numbers, what they care about is your debt servicing ratio. So how much of your check goes to servicing debts that you can't get out of every month they're coming out of that account. So if you had $1,000 coming in, how much is going to your Visa? How much is going to your car payment? How much is going to, that unsecured line of credit?
Yeah.
All of these things, they want that threshold to be low enough that they don't feel like you're overextending on debt. So the more money you make or the less debt you have to service, that improves your borrowing ability. There might be someone out there making $100,000, but because they have all this debt to service, they actually qualify for a smaller mortgage than someone who's making $50,000.
Yep.
It all depends on how much debt you have. And everyone, even if someone has really good savings and doesn't overextend themselves, almost everyone has a car payment. And I asked you something about this because I know you know cars really well. There are cases where people are financing their vehicle and finding, well, because of my big car payment, I'm only, quote unquote, getting approved for, say, $300,000.
Yep.
But you can potentially change your financing on that car to get approved for more, right?
Exactly. Yeah. So depending on your financing setup, there's sometimes an opportunity to renegotiate or do a whole new term. Similar to a home, you can buy out your current one and get a new lease setup or a new finance setup to extend it. Because when you look at some people, they're going to be buying the used car. Technically, they'd be starting in a fresh finance period on that vehicle, even though you already own it, only have a few years left. So there are options. The biggest thing that really plays into it is having a bit of equity in the vehicle. Basically, that's the biggest one. You need to have a bit of equity in the vehicle because if you're very upside down, it's tough for them to renegotiate or reset up your financing because nobody's going to step in on a vehicle that you're already upside down on. Mm-hmm. In those situations, it can be tough if you can maybe find a new vehicle to swap into. But in general, if you have a bit of equity and you really need to get that payment down, there's options to sometimes extend it. And I see that with some more expensive vehicles sometimes. Like if you buy a fancy pickup truck, your payment might have been $800-900 and you're almost paid down now. You only owe $10,000 left on it.
Yeah.
Pickup trucks hold value.
Sucker.
Exactly.
Yeah.
And you can, it's funny as it sounds, you can literally refinance vehicles and walk away with cash in hand. Now, where vehicle financing is not the cheapest option out there, typically don't suggest using vehicles to get cash back.
No.
But there has been clients that have done that, or people who already own a vehicle cash. You're like, crap, like I thought it made the most sense for me to go out and buy this vehicle, $60,000 cash. So I slapped it down. Now I want a house, and I'm like, I don't have this cash. You can go into a financing center and say, hey, let's do a $30,000 against my car, and they'll give you the $30,000. You do a standardized car loan, and you can get that money out. So you're not always.
That's a little interesting caveat for people looking for down payment.
Yeah.
But just to simplify the idea is, say you've got a $400 a month car payment because you're financing this car. You could renegotiate your finance terms and perhaps bring that down to $300 a month.
Yep.
And you're like, oh, $100 a month, though, how's that going to help me? $100 right now on your mortgage application, you free that money up. That's that's $25,000.
20 grand, yeah.
$20,000 to $20,000 of approval. So that takes you maybe from $280 to $300.
Which could be the difference.
Could be a huge difference.
Yeah.
Right. So you do that. Another one is your student loans. You can also often call in and get your student loans reduced down. Not the amount, but the actual payment that you make. You can sometimes switch things to interest only for a period of time. You can get these payments down on your month to month, which in turn will increase your borrowing ability. And all of these things, all of these little insights, all these little, not tricks, because they're just a better way of moving your money around, can be, explained to you by a good mortgage professional.
Exactly.
So that's why a really, really good pre-approval matters. And it really matters right now because there are times where it's like, hey guys, we're not finding anything in your price point. Can you go back to that broker and see if there's anything we can work out here?
40 out of them.
Yeah, and see what can be done. And if you can clear some debt, if you can reduce some payments, you can get that approval up and it can make all the difference in a competitive market.
Big time.
The last thing I will mention, always ask them to hold your rate and for how long it's going to be held for. Because we've been talking about inflation. We both feel like interest rates are going to go up.
Yep.
You'd be surprised how many times I've asked people like, well, when does your rate expire and what is your rate? And like, I don't know, they just approved us for this amount. It's like, yeah, that's your amount at this interest rate. But if we don't get a home in the next 120 days and your interest rate goes up by, half a point, like then what do you approve for?
You just lost 40 grand.
Yeah. Yeah.
And so, usually they're good for about 90 to 120 days. That's what I've seen on most of them. Right now, too, they're approving people at around 5.25% for CMHC, which is quite a bit. Obviously, people know that you're signing rates more like 2% for mortgages, but they're qualifying you at 5 plus for an interest rate. And that is indicative of the fact that rates are likely going to creep. They usually, if they're approving you at a much higher rate and they are kind of increasing that benchmark, which they recently did, that's a suggestion that rates will follow. Yeah.
That's called stress testing, where they say, okay, we know we're going to give you a mortgage at 2%, but we want to see, could you also pay it if it was 5.5%, i.e. if it goes up in the future. So boom, you've got a great pre-approval with someone who you've got a good vibe with, that you can be totally transparent with, and you've squeezed
that's
your
the last
borrowing
thing. You got to make
ability.
sure your vibe's good.
Yeah, because you need to have these candid conversations. Well, why is this thing on your credit? How do you report your income? You want to have a good rapport with them.
Thanks for watching that clip from Master Keys Podcast. Check out that full episode here. Don't forget to subscribe, hit the like button, and share our podcast.
When I was broke, I had rich habits. When I was broke, I had rich habits.